The shocking reason banks are failing. The Silicon Valley Bank has been seized by bank regulators in the US. This marks the largest bank failure since the financial crisis of 2008, which has led customers to take their money out from quite a few banks out there. In this video, we will talk about if the failure of the Silicon Valley Bank is an isolated event, or if there is a huge crisis waiting in the wings for the entire banking industry. So stay tuned. But before we continue further, I would request you to subscribe to the channel. Thank you. The whole banking industry rests on the principle of storing your money safely. This is perhaps the most important reason why we go to the bank to keep our money. But if banks are supposed to be robust and provide you with a sense of relief, then how is the entire banking industry in the hot water? To begin understanding this, let's first talk about how the Silicon Valley Bank began. The company was founded in 1982, which cemented its position in the market as a leader, which specialized in venture capitalism projects. This became the go-to financial institution for promising startups, where CEOs and businesses would go to meet their financial needs. All of this panned out excellently in the initial years. However, since the pandemic began, interest rates were reduced to zero, and stimulus packages were put in place, due to which money was pumped into the system. The money eventually found its way back into the banks. Most banks today operate on the fractional reserve banking principle, which basically means the banks are required to keep 10% of its money available for customers who would be in need of withdrawals. So, in layman's terms, if you give $1,000 to your best friend for best keeping, then according to the fractional reserve banking principle, I have to keep $100 available for withdrawals. I can do as I please with the remaining $900, and if I gave that away to somebody else, then they are obligated to keep only 10% of that in cash, and so on and so forth. You get the picture. This means that the banks are operating on the assumption that they will have enough people with their deposits that it would offset the withdrawals that other customers want to make. The obvious benefit of resorting to this practice is that it gives enough leverage to the banks for earning profits through interest on the remainder of the amount. However, there is another corollary. Everybody has to trust that the system works so that people don't rush their banks to cash out their money. Imagine what would happen if people started believing that the system had started to break down and that they withdraw their money at the same time. This lies at the core of the modern banking dilemma. Now, let me tell you that all banks are not in the habit of lending out to other banks, which are lending out to other banks, and it keeps happening in a vicious cycle. Rather, most banks only invest the remainder of their amounts in very safe investments, such as the US Treasuries, so that they can cash in on sure and steady returns. This means that as long as those treasuries mature, the banks will get their projected returns. This is a win-win. Sadly, this did not happen for the Silicon Valley Bank in 2021 and 2022 because the bank invested almost $100 billion in government-backed bonds. The bank was betting against a steep increase in the interest rates, which the Federal Reserve did announce, by the way. The sharp increase in the interest rates put the bank in a very unfortunate position. The bank simply ended up on the losing end of this bargain. But how did the bank end up being in that unfortunate position? Let's try to understand that with an example. Suppose a person X invested $100 on an interest rate of 2% for the next 4 years, provided they could hold it for the next 4 years. At this rate of interest, they would walk away with $108.24. Not bad. Now, suppose this person X had just made that investment, and after the investment, the rates of interest suddenly increased to 7%, which means you could basically have the same deal and walk away with $131 after 4 years. How does that change the initial equation? This means that the person X's investment of $100 has declined in value to only $77, since the profits are $28 more than what this initial investment could have given. At this rate, this person cannot take out their money because it would still be a loss. Now replace the person X with Silicon Valley Bank, and you will have understood what really happened. In this case, all banks have enough cash to cover a large amount of withdrawals, but in the case of tech companies, this would mean more capital than what the bank could provide at the moment. The bank locked away a sizable chunk of its money in one specific asset, which did not yield a higher rate of return, and the customers wanted their money back too. Things escalated for the company at an unprecedented pace too. On March 8th, the company wanted to sell off a third of its stocks to raise $2.25 billion USD, and by the next day, there were rumors that the company could be facing insolvency. This speculation led to a decline in their stock value by more than 60%, which put additional funding at a risk. The bank was facing a full-fledged panic situation at this moment. The CEO was trying to reassure its clients that their money was in safe hands, but it was the startups which pulled out as soon as they did. On the 10th of March, the company simply announced that they were looking for someone to take over because they did not have enough to pay for what they had, and that they had literally run out of money to give. But wasn't the bank insured by FDIC? When you deposit money into a bank that is insured by the FDIC, your funds are protected up to a certain amount per depositor, per insured bank. The current standard insurance amount is $250,000 per depositor, per insured bank for each account ownership category. Fortunately, only about 5% of people are affected by this, as most people have less than $250,000 in the bank. The ones that were most affected were venture capitalists and business owners. Although these startups will not be reduced to a zero overnight, but it could mean that the businesses could take years to recover all that money. This also leads to another important question. Can this happen to your bank? The answer is that although it's possible, but it's highly unlikely. The Silicon Valley Bank invested in a specific niche, which made them bet against the odds, which obviously did not work out for them. Losses in an environment where everyone was taking money out was the killing blow for the bank. To stay safe, never keep more than $250,000 in the bank due to FDIC insurance. So, never put all your eggs in a single basket. That concludes today's video. Please like and share this video and subscribe to our channel. Thank you.